Hello traders, and welcome to the Technical Trade Room. My name is Joseph, and in today's educational video, we're going to cover the basics of stock options trading. Alright everybody, as always, I need to start with a quick disclaimer. Statements by TTR or its members are opinions and not investment advice. TTR is not responsible for any investment decisions made using the information provided. Improvements are not guaranteed. This material does not take into account your particular investment objectives, financial situation, or needs and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on TTR. Phew, that is a mouthful. Well, with that out of the way, let's get down to business. To start, let's cover some basic concepts behind options trading. Options are contracts between two traders that gives to the buyer the right to buy or sell a stock from the contract seller on or by a specific date at an agreed upon price, and to the seller the obligation to buy or sell a stock to the contract buyer on or by a specific date for that agreed upon price. A single options contract is for 100 shares of a particular stock. However, it is important to note that the contract buyer does not have to pay for all 100 shares up front. Far less capital is needed to open the contract. In fact, in exchange for the contract, the options buyer pays the seller what we call a premium for the contract, which requires a much smaller initial investment. Use it or lose it. Every options contract has an expiration date, and some brokers may even automatically execute an options contract for the buyer if they have the available funds to do so, and executing that contract would be favorable or profitable to the buyer. Finally, executing the contract is completely optional, which is why we call them options contracts in the first place. The first thing you're going to want to know about options contracts is that there are generally two different types of options. First are calls, which give the right to the buyer to buy 100 shares of a particular stock at an agreed upon price, also known as the strike price. Second are puts, which give the right to the buyer to sell 100 shares of a particular stock at the agreed upon strike price. Next, let's go over how to read an options code, as you will need to understand what all the letters and numbers mean, because you're going to see a lot of them, and you'll be able to now make sure you're buying and selling the right options contract. Here, we have an options contract for Tesla. The first part of the code, in blue, will consist of letters, as this is the ticker symbol, which indicates which stock the option is for. Always make sure that the ticker symbol matches up to the stock that you're looking into. Next, in yellow, we have the expiration date of the contract. Self-explanatory, after the trading day for the expiration date listed, the contract will expire, so the contract must be used on or before that date. The date is as follows. First we have the year, then we have the month, and then we have the day of that month. Next, in red, we have the indication of whether or not if this is a call, which is noted with a C currently on the presentation, or a put, which is noted with a P. Finally, in green, we have the strike price, which is the agreed upon price for the contract. So, in closing, altogether, we have a September 22nd, 2017 put for Tesla at a strike price of $350. Now I'd like to cover a very important part of options trading, and that would be the difference between buying and selling options. If you have an understanding of stock lingo, then you're familiar with the terms of going long and being short on a position. Well, those same terms are present here but have very different meanings. First, if you are buying an option or you buy to open a position, you are considered long here, regardless of whether or not you're buying a call or a put. If you buy an option, you are buying the rights to either buy or sell a particular stock at the agreed upon strike price. Second, if you are selling an option or you sell to open a position, you are considered short here, regardless if you're selling a call or a put. If you sell an option, you are obligated to either buy or sell a particular stock at the agreed upon strike price. It's important to note here that if you buy to open a position, you are paying the seller of the contract a premium for that call or put. And if you sell to open a position, you are receiving a contract premium from the buyer for that contract. Now that we know the difference between buying and selling option contracts, let's cover how you can open and then close those positions. If you buy to open a position, then you are paying the option seller the premium for the contract, which is why I've noted this position with a debit. Now, let's say that after opening that position, you 1. No longer think the stock will go in the direction that you originally thought, or 2. The option is being sold for a much higher price than you originally bought it for, then you may want to sell it. If this is the case, then you would want to sell to close the position. If you sell to close that position, then you are looking for another contract buyer to buy out your rights to the options contract. And then just like a contract seller, you will receive a premium for the contract. So I've noted this with a credit. But don't worry, you will not be obligated to buy or sell the shares after it's sold. That responsibility will remain with the original contract seller. Now, if you want to sell a call or put, then you'll want to sell to open a position. And if that order is filled, you will get paid a contract premium from the buyer. So I've labeled this with a credit. Now, let's say that you, 1, think the contract is in danger of being executed, and taking a hit on the premium would be less than the loss that you would get from the contract being executed, or 2, the same option is currently being sold for a much lower price than you originally sold it for, then you may want someone else to buy the contract from you. If this is the case, then you would want to buy to close the position. If you buy to close the position, then you are looking for another trader to take over your obligations for the contract. You are paying them a premium to take over that previous contract. So I've noted this with a debit. Now that we've covered option basics and how to open and close positions, let's talk about situations where you would want to buy or sell options contracts. On our graph, the 2 top quadrants will represent buying positions, while the bottom 2 quadrants will represent selling positions. The 2 left quadrants will cover calls, while the 2 right quadrants will cover puts. Let's start by covering situations in which you'd like to buy options. First, let's say that you think a stock is going to go up in time. Then you may want to buy a call option, as you will be locking in a purchase price that you hope will be much lower than the stock's price in the future. Second, let's say that you think the opposite is going to happen and you think that the stock is going to go down in time. Then you may want to buy a put option, as you will be locking in a sell price that you hope will be much higher than the stock's price in the future. Alright, now let's cover situations in which you may want to consider selling options contracts. First, let's say that you think the stock is going to stay around the current price, also known as moving sideways, or go down in price. Then you may want to sell a call option, as you will receive a premium for that contract and will get to hold on to that money so long as the contract expires without being executed in the money. Second, let's say that you think a stock is going to move sideways or go up in price. Then you may want to sell a put option, as you will receive a premium for the contract and will get to hold on to that money so long as the contract expires without being executed in the money. So what exactly is all of this talk about in the money that I just mentioned? Well, let's cover the 3 major terms that you're going to hear and read about that talk about profitable, losing, and break-even options contracts. First, let's talk about in-the-money options, often abbreviated as ITM options. In-the-money options are contracts that, if executed, would lead to a profit for the contract holder. So, for example, let's say you have a $5 call when the stock is currently $10. If executed, the contract holder would be buying $1,000 worth of stock for $500, netting them a $500 gain. It's important to note here that for these examples, I am not taking into account the premiums paid to the contract seller, which at the end of the day would be removed from the total profit of that particular option. Second, let's talk about out-of-the-money or OTM contracts. Out-of-the-money options are contracts that, if executed, would lead to a loss for the contract holder. So for example, a $5 put when the stock is currently selling for $10. If executed, that contract holder would be selling $1,000 worth of stock for only $500, netting them a $500 loss. So remember, Options are completely optional, and out-of-the-money options are best left to expire, so you only lose the premium that you invested in the contract. Third, let's talk about at-the-money or ATM contracts. At-the-money options are contracts that, if executed, would break even as the strike price is identical to the stock's current market price. So for example, a $5 call when the stock is currently selling for $5, if executed, the contract holder would be buying $500 worth of stock for $500. It's important to note here that the contract holder will technically net a loss. Again, we need to take into consideration that premium paid, so that will lead to a small loss for the options holder. Finally, it's important to note again that some brokers will only automatically execute expiring contracts that are in the money, and that will be at the last market price of the expiration date, so long as the options holder has the available funds to do so. This is a service that's provided to investors in case they forget about the option and would have missed out on a positive transaction. You're going to want to check with your broker's terms of service and how they handle options to see if this will apply for you. If you're not currently using options trading as a part of expanding your portfolio, let me give you two major reasons why you should give it some serious consideration. First, options contracts require a significantly smaller initial investment. So for example, if I were to buy 100 shares of Microsoft at $74.50, that would require a $7,450 investment just to open the position. But if I were to buy a Microsoft October 6, 2017 call at $74.50, that would only cost me $51 for the contract. I'll still own the rights to purchase the 100 shares, but I paid a fraction of the cost for it. Now, let's say that Microsoft rises to $77 by October 6th. The following would happen. The owner of the stock could cash in their total position and collect $7,700, which would be a $250 profit from their initial investment, or a 3.36% gain. The options holder, on the other hand, would execute their call option to purchase the 100 shares of Microsoft at the $74.50 strike price and then sell it for the current price of $77. Although they would forfeit the premium they paid, which was only $51 here, the options holder would pocket $199, or they would see a 390% gain on their $51 investment. Now let's go in the opposite direction. Let's say that Microsoft falls to $72 by October 6th. The following would happen. The stock owner would be down $250 from their initial investment, or they'd have a 3.36% loss. The options holder, on the other hand, would simply allow their contract to expire and only lose the premium paid, which was $51. Although the stock owner could retain the stock and potentially see a rise to see a better selling opportunity in the future, the stockholder has lost $199 more than the options holder at this time. The second reason you would want to consider adding options to your portfolio is that options allow you to hedge your positions, as a purchased option comes with a fixed amount of loss. Loss management is extremely important to successful trading. So let's make that a little easier to understand with an example. If I own 100 shares of Microsoft at $74.50 a share, I have an investment worth $7,450. Now, let's say I purchase a put option at a strike price of $74.50 for Microsoft at $51, and that's the cost to me. If Microsoft rises to $77, my put contract, yes, would eat into my would-be profits of $250 and net me only $199, but if Microsoft were to fall to $72, my put contract would allow me to sell my shares at that strike price of $74.50, and I would technically only lose the premium that I paid for the put contract. That would save me a total of $199. Options can allow you to hedge your investments, limit your losses, and see greater gains. You should give it serious consideration for your portfolio. Alright everybody, I know we covered a lot of material in a very short period of time, but here are some major points I'd like you to take home. There are two types of options. The first are calls, which give you the right to buy stocks at a particular price, and the second are puts, which give you the right to sell at a particular price. Options are contracts between two traders that 1. Gives the buyer the right to buy or sell 100 shares of a stock from the seller on or by a specific date for an agreed upon price, known as the strike price, and 2. Gives the seller the obligation to buy or sell 100 shares of a stock to the buyer on or by a specific date for that agreed upon strike price. Options have an expiration date, and executing the contract as a buyer is completely optional. Options contracts require significantly less capital to participate in and can realize greater gains. Option holders have a fixed amount of loss, and options are a great way to hedge your positions. Options are also a great way to make money on a sideways moving stock that you own shares in. And finally, you can buy and sell stock options just as you would shares of stock without ever having to execute those contracts. I'd now like to take this time to extend an invitation for you to come join the Technical Trade Room. If you're interested in technical analysis or looking for a great community to be a part of, please feel free to come join our outstanding equity trading community on Discord. We offer the following for free to all of our members: daily stock market conversations, real-time voice chatting, daily and weekly watch list, access to knowledgeable traders, free Thinkorswim studies and scanners, and educational videos just like this one. Thank you so much for watching, everybody. Please like this video and subscribe to our channel for future TTR content. We wish you good trading and hope to trade better together with you. This is Joseph from TTR, signing off.